The global shipping industry is undergoing a significant transformation, catalyzed by the disruptive impacts of the COVID-19 pandemic. This transformative process is reshaping the dynamics of shipping container operations, forcing the industry to adapt and evolve rapidly to remain profitable. During the peak of the pandemic, the global movement of containers came to a near standstill. As manufacturing shut down operations and factories closed, many containers used for shipping goods found themselves stranded at ports or storage depots, rendering them surplus to requirements. Simultaneously, freight shippers decreased vessel deployments due to the slowdown in manufacturing, further constricting the shipping capacity and disrupting the global flow of containers and goods. This situation created a paradox where certain regions had a surplus of unused containers while others experienced severe shortages. As the pandemic gradually subsided and the global economy embarked on a path to recovery, labor shortages and port congestion compounded the problem. Many surplus containers remained stranded where they were no longer needed. This unexpected surplus of containers led to an overcrowding of container storage depots, with some facilities being compelled to reject new clients due to insufficient space. In some cases, shippers even resorted to giving away containers to free up space. To manage fluctuations in demand and capacity, blank and canceled sailings have become increasingly common as shipping companies opt to skip ports or cancel entire trips. This situation underscores the industry's resilience and the ability to adapt, even in the face of unforeseen challenges. Container shipping, a cornerstone of global trade, has swiftly responded to shifting dynamics. This shift has not only reshaped the industry's physical operations, but has also accelerated the option of digital solutions and technology, such as blockchain and data analytics, to optimize container management and improve efficiency. In the realm of trade and commerce, this transformation has compelled businesses to reassess and readjust their supply chain strategies. They must adapt to the evolving shipping landscape to ensure a smooth and efficient movement of goods. Large-scale retail chains and e-commerce giants, such as Walmart and Amazon, have extended their operations by adding in-house pharmacy services, allowing customers to fulfill their prescriptions while shopping. Additionally, more consumers are turning to medication delivery apps to receive their prescriptions at their doorstep. The restructuring of the container shipping industry also raises questions about the future of the neighborhood pharmacy. Many consumers who have long lamented their experiences at traditional drugstores may not be deeply concerned about this transformation. These brick-and-mortar stores have struggled to provide an attractive shopping environment, typically poorly lit, lacking in customer service, products often locked behind counters, limited staff assistance, and comparatively high prices when compared to other retail options. Rite Aid, a significant player in the drugstore industry, recently filed for Chapter 11 bankruptcy protection, signaling the ongoing challenges faced by traditional pharmacies. The bankruptcy filing was expected, as Rite Aid had faced dire financial difficulties for years, consistently losing money and closing stores in an attempt to cut expenses. In addition to these financial issues, the company was facing a substantial charge related to its role in the opioid crisis. This situation reflects the broader challenges confronting many large drugstore chains. Poor decisions, significant debt, and failed deals had contributed to Rite Aid's downfall. One key misstep was its acquisition of Brooks & Eckerd chains in 2007, financed with borrowed money and additional debt from a former parent company, Jean Coutu Group. Even when Rite Aid entered negotiations to be acquired by Walgreens, the deal fell through. Ultimately, Walgreens sold nearly 2,000 stores, leaving Rite Aid without a lifeline. The significant debt burden hindered Rite Aid's ability to invest in its stores and diversify into new business areas, as its competitors CVS and Walgreens did. The evolving landscape of container shipping and the transformation of the drugstore industry underscores the dynamic nature of global commerce. As industries adapt to unforeseen challenges and opportunities, they often emerge from adversity with new innovations and strategies. These changes impact not only businesses but also consumers, who can expect different options and experiences in the coming years. Despite these transformations, physical pharmacies are expected to remain, albeit in a somewhat smaller capacity than before. In parallel, shifts in economic landscapes are affecting China, the world's most populous nation and a key player in the global economy. Recent data indicates that China's economic growth in the last quarter likely fell short of Beijing's annual target for 2023. This underperformance is attributed to challenges in the property sector and subdued demand, raising concerns about the fragility of China's economic recovery. Analysts predict that China's gross domestic product expanded by approximately 4.5% in the third quarter of 2023, comparing it to the same period in the previous year. This falls below Beijing's annual target of approximately 5% growth. While GDP growth from the previous quarter showed slight improvement, Other key economic indicators, including industrial output, retail sales, investment, and unemployment, have also raised concerns. The data suggests that policymakers need to implement more measures to support China's economy. Although the stimulus measures adopted thus far have had some positive effects, such as improving in factory activity and a slowdown in the decline of exports, there have been challenges. For instance, consumer prices in September approached deflationary levels and loan growth remained weak. The current economic indicators are mixed, which has led some economists to be cautious about whether China can meet its growth targets for 2023. To address the economic challenges, Chinese authorities are exploring options such as increasing the budget deficit by issuing more debt for infrastructure spending and bolstering stock market confidence. Economists anticipate further interest rate cuts and adjustments to bank reserve requirement ratios to stimulate economic growth. However, there is still uncertainty about China's economic trajectory, with some economists predicting a potential triple dip toward the end of 2023 or early 2024. This uncertainty emphasizes the need for continued monitoring and potential adjustments to support China's economic recovery. While economic changes and container shipping dynamics evolve, the tech industry is experiencing shifts in the competitive landscape. Apple, long regarded as a leader in the smartphone market in China, is now facing a substantial challenge. Jefferies analysts have reported that Apple's iPhone market share in China has been declining significantly, while the smartphone market in China has seen positive year-after-year growth, led by high double-digit growth in Android sales. Apple's iPhone sales have experienced a notable double-digit decline. This decline in volume began with the launch of the iPhone 15 and has resulted in Huawei surpassing the iPhone as the leader in market share. Jefferies analysts have suggested that Apple's weakening demand in China could result in lower than expected global shipments in the iPhone 15 in 2023, potentially leading to Huawei overtaking Apple on a global scale. The impact on the Chinese market share is not solely due to discounts, as iPhone discounts, excluding iPhone 15 models, have remained stable. In contrast, Android's discounting price is not significantly high. Additionally, the resale market for iPhone 15 devices reflects a weak demand, as these devices are trading at discounts compared to official selling prices. Adding to the challenge, analysts at Morgan Stanley have adjusted their price target for Apple, expressing caution about the company's performance in the December quarter due to supply chain disruptions. They have also lowered their expectations for iPhone sales during that period. The performance of Apple in the coming months, including total revenue, services revenue growth, gross margin, and revenue growth in China, will be closely monitored. Nonetheless, the guidance provided for the December quarter will be crucial determinants of Apple's trajectory in the competitive smartphone market. As these narratives unfold, they underscore the continuous shifts and adaptations in various sectors, both in response to external forces and in pursuit of growth and innovation. Businesses, governments, and consumers alike must navigate these changing landscapes and remain flexible in their strategies and expectations. In conclusion, these challenges we're seeing in our economic landscape could potentially lead to bankruptcies, delinquencies, defaults, and even the collapse of the small to mid-sized banking system. This is especially concerning if China's economy takes a significant hit. So as we navigate these treacherous waters, keep a keen eye on the economic indicators, because they hold the key to our financial future. Stay tuned and stay informed.